Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST Space Mobile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so AST SpaceMobile. This feels like a classic high-growth infrastructure story, a company moving from R&D into, well, the very first stages of commercialization.
Exactly. And the core promise here is huge. We're talking about space-based cellular broadband delivered directly to a standard, completely unmodified 4G or 5G smartphone.
No special equipment, just your phone. That's the hook.
It is. And we're finally seeing that promise start to translate into real financial numbers. That's the inflection point everyone's been watching for.
Right. Let's talk about those recent results. Q3 2025 revenue came in at what, $14.7 million?
Yes, $14.7 million. And on its own, that number might sound small, but you have to look at the context.
The growth.
The growth. It's over a 1,200% year-over-year increase from just $1.1 million. That's not just a small step up. It's a signal that there's real demand.
And what about the forward guidance? Because that's what really caught my eye.
Management guided to between $50 and $75 million in revenue for the second half of 2025.
So given the Q3 number, that implies a massive jump in Q4.
A massive sequential step up. If they hit that, it really validates the whole model is starting to work.
But with this kind of build out, they must be burning cash. What's the bottom line look like?
Oh, absolutely. You can't look at this through a normal profitability lens yet. The EPS is still negative at -$0.45.
But it's narrowing.
It's narrowing significantly. A year ago, it was -$1.10.
That's a huge improvement. It points to operating leverage, right? As revenue starts to scale against their fixed costs.
That's exactly it. It's the first sign that the economic model can actually work once they get the infrastructure in place.
Okay, so the top line is accelerating. But for an infrastructure play like this, revenue visibility is everything. You need to know the demand is locked in.
And that's where their contract mode comes in. The company secured over $1.0 billion in aggregate contracted revenue commitments.
$1 billion. From who? We're talking about major players.
The biggest players. We're talking concrete MNO relationships with AT&T, Verizon, Vodafone, the Super Group.
So these partners give them distribution and, crucially, access to the right spectrum.
They do. And it's more than just a promise. Look at the Super Group. They committed a $175 million prepayment for future services.
A prepayment. So that's cash in the door right now.
Cash in the door. It's a huge vote of confidence, and it helps fund this heavy CapEx phase.
Which brings us to their financial war chest. To build this constellation, they need a ton of capital. Do they have the runway?
They do, and this is a key part of the bull case. The company is holding approximately $3.2 billion in cash and equivalents.
That's a very comfortable cushion.
It gives them ample runway for the initial deployment. And they were smart about how they raised it. They recently issued a $1 billion private convertible senior note offering.
So long-term debt that can be converted to shares due in 2036, which is way out there.
Right. And demand was so strong they actually upsized the offering. But here's the most important detail.
The conversion price.
The conversion price. It's set really high, around $96.30 per share.
Wow. So the lenders only make money on the conversion if the stock price goes up, what, multiples from where it is today?
Exactly. It's a huge institutional bet on the long-term value of the equity, and for current shareholders, it limits any near-term dilution risk.
It seems like a supportive structure, not a predatory one. And are they spending that money efficiently? What are the unit economics per satellite?
Management estimates the average cost for a Block 2 Bluebird satellite, including the launch, is pretty efficient, between $21 and $23 million.
That number is critical for modeling out the total cost and figuring out when they might actually become free cash flow positive.
It de-risks the whole CapEx plan significantly.
Okay, let's shift to competitive advantage. Why is this so hard to replicate? I mean, we hear about other companies launching satellites all the time.
The moat is really in the specific technology. It's their proprietary large aperture satellite architecture. And just as important, their use of L&S band spectrum rights.
And why are those bands so special?
Because those are the bands that standard mobile phones already use to talk to cell towers.
So their satellites speak the same language as the phone in your pocket.
Precisely. That's the key differentiator. Many competitors are focused on, say, low bandwidth text messaging, which is useful, but it's a niche.
Whereas AST SpaceMobile is going for actual broadband, voice, data, the whole package.
Right. It expands the market from just emergency services to literally every mobile phone user on the planet. The friction for adoption is almost zero.
And to protect that lead, they must be scaling production like crazy.
They're expanding their manufacturing in Texas and Florida, and they've doubled their workforce in just 6 months to accelerate production.
Okay, that's a powerful bull case. But let's talk about the other side. What's the big risk here? Where could this all go wrong?
Execution. Full stop. The entire story hinges on flawless execution.
Because they are burning an incredible amount of cash to build this out.
An extraordinary amount. They guided Q4 capex to be between $275 and $325 million. They are deeply, deeply pre-profit.
So any delay, any technical setback immediately puts pressure on that cash pile.
Exactly. The business depends on the flawless deployment of these really complex satellites. A delay with the upcoming Bluebird 6 launch, for example, could shake partner confidence and push the whole timeline back.
And we saw how sensitive investors are to this, right? The stock dropped on the financing news.
It did. It fell about 7.3%, even though the terms were actually very favorable. It just shows how concerned investors are about anything that even hints at future dilution risk.
Let's talk about that market sentiment. What are the signals from, the smart money?
It's mixed, but I'd say constructive. The market punishes funding news, but it strongly rewards execution updates, like progress on a Bluebird 6 satellite. Milestones matter more than anything right now.
Did we see any insider buying?
We did. A director, Keith R. Larson, bought some shares on the open market in December. Wasn't a huge amount, but any insider buying during a phase like this is generally seen as a strong signal of confidence.
But on the flip side, there was that big sale from American Tower.
Yes, Tower Corp sold about 91% of their stake. That caused an 11.6% drop and definitely raised some questions.
Even though it was framed as just taking profits.
Right. But when a major sophisticated holder exits, the market gets nervous. You have to ask, was it just portfolio management, or did they see a valuation ceiling that others are missing? It adds a layer of complexity.
So, boiling it all down, what are the key catalysts we should all be watching for in the next few months?
Number one is the Bluebird 6 launch. That satellite is built, tested, and on its way to India. The successful deployment is the single biggest de-risking event on the horizon.
If it flies, the stock flies.
Pretty much. Then second is the Q4 2025 earnings release. Investors need to see them hit that aggressive revenue target, that $15 to $75 million second half number.
To prove the commercial model is truly starting to fire.
Exactly. And finally, just continued news on partnerships, new commercial service regions, deeper integration. Every announcement locks in that long-term revenue.
When you zoom out, it really is a winner-take-most bet, isn't it? The combination of their tech, the spectrum rights, the carrier partnerships, it creates an asset that's just incredibly difficult to replicate.
That's the long-term thesis, a powerful, defensible, global infrastructure asset.
Which brings it all back to the core question. The value here isn't about today's revenue, it's tied to the future free cash flow, which some analysts see turning positive by 2028.
It is a classic long-duration asset play. It requires patience.
So the real question for you as an investor isn't whether they're profitable now. We know they're not. It's whether you believe this team can execute the deployment of, 45 to 60 complex satellites over the next couple of years.
That's the trade-off.
If they can pull it off, the upside could be massive. But if they stumble, the execution risk and the dilution risk become very, very real.
Would hope this analysis was insightful.
If you want more talks like this, please remember to subscribe to Smart Wealth with Joshua.